Welcome everyone to my first update film from home for the quarter ended 31 March 2020. I'm going to give you an update on market performance for the quarter, and then I'm going to put that into some perspective by looking at performance over longer time periods as well. There is no way to begin a market update this quarter without addressing the COVID-19 pandemic. I'm filming this standing up so that you know that even in lockdown, I'm not wearing my shorts. I won't go into details about the pandemic or the timeline thereof. That's been really well covered by many other people. I will point out our own webpage on the COVID-19 outbreak, where we've included everything we've sent to you about the outbreak, including our response. We've also included some ideas from staff members on how to while away your time in lockdown. I'm here to talk about markets, and markets have responded poorly to the pandemic. Governments, at least fiscally, have responded really well. From New Zealand's initially world-leading 4% of GDP bailout package, subsequently increased, only to be trumped by the United States' $2 trillion or 10% of GDP package. That's a really big deal. But what does it mean for markets? This is a short snapshot that shows the growth of $1 over the 3 months ended 31 March. Maybe growth is the wrong word here. After a good start in January, things went downhill in February and March for all growth asset classes. The top performers for this quarter were international fixed interest hedged to the New Zealand dollar and New Zealand fixed interest, where $1 would have grown to around about $1.01 for both. The flat green line, well, that's New Zealand dollar cash. And just like any other bank account, $1 invested at the start of the 3 months would have basically remained $1 by the end of the 3 months. In this case, it would have grown by 0.2%. Now, the leader, if that's the right way of putting it, in terms of declines, was the S&P ASX 200. $1 invested in Australian shares at the beginning of the month would have declined to 76 cents by the end of 3 months. The next worst was international shares hedged to the New Zealand dollars, which would have declined to around about 79 cents. The best of the bad bunch was a 50-50 mix of shares and cash and fixed interest, which would have declined to around about 88 cents. Not a great quarter. In fact, it's the worst quarter since the 1987 stock market crash. Ouch. Not a great way to start. But how about the year? Not a great deal better, I'm afraid. Over the course of 1 year, international fixed interest and New Zealand fixed interest are still the leaders of the pack, having grown to $1.06 and $1.04 respectively. Australian shares and international shares hedged to the New Zealand dollar still lead the way in terms of declines, and that 50-50 mix of cash and fixed interest and shares would have declined to around about 93 cents. Yikes! I'm starting to wonder if I've got any good news for you. Let's find out. Well, yes, as it happens, it does get better. This is the same information, but this time spread over 3 years. And while that March 2020 quarter certainly does stand out as a steep decline at the end, every growth asset class, except Australian shares, did in fact grow. In fact, a 50-50 mix of shares and cash and fixed interest would have grown from $1 to around about $1.14. Somewhat muted growth, but growth nonetheless. But what about over longer time periods? How about the longest time period we could find? This slide might be familiar to you. We sent this slide to you a little over a week ago in our blog post titled Market Falls in Recovery. It shows $1 invested in the S&P 500 index all the way up to the end of March. That's 90 years of rich data based on the top 500 companies in the United States by size. Over this time period, the world has faced a lot of crises and events. The Great Depression, the Second World War, oil shocks, the Cuban Missile Crisis, the global financial crisis. These were all events that those who experienced them worried might lead to the end of the world. In fact, some of these events even had nuclear missiles pointed at countries. but they never did result in the end of the world. In fact, after every share market decline that could be associated with these events, markets not only recovered, but reached all-time highs. We don't know when markets will recover, but we do know that they will. The only way for you to participate fully in that recovery is to remain patient and stay invested. I hope you found this market update interesting and maybe helpful. I look forward to updating you again at the end of the next quarter, and thanks for watching.